Hey folks, and welcome to a new episode of the MRC podcast. My name is Moritz Weber-Schön, and today's guest, Craig Coben, former Vice Chairman of Global Capital Markets at Bank of America. Craig was educated at Yale and Harvard Law School, then worked as a lawyer and joined Deutsche Bank as an ECM banker in 1997. He then joined Bank of America in 2005, where he headed equity capital markets from 2014 onwards and became vice chairman of global capital markets in 2018. You worked in equity capital markets for over 20 years and still write about capital markets as an author. What fascinates you about it every day, still today?
Well, the capital markets are always changing. You learn something new every day. And I think the role of capital markets is particularly relevant given the growth of private markets and the stakes right now for many countries as they try to democratize capitalism, as they try to share the wealth of capital appreciation. Capital, the public capital markets are the best way to do that. And right now, their role is gradually being eroded. And that's been a subject that I've written quite a lot about.
Could you now tell us a little bit about the beginning of your career? What motivated you to study law?
So everyone's career is different and everyone's life is different. What I would say is it doesn't really matter what you study. It matters how you study. What you learn in university is never going to be relevant to what you actually do on a day-to-day basis. Even as a lawyer, what I learned as a lawyer wasn't relevant. As a law student, wasn't relevant when I became a lawyer. I had to learn everything from scratch. You learn on the job. I wanted to become a lawyer, I think in large part because I didn't know what to do with myself and what to do with my life. And studying law was a way of deferring that decision and keeping my options open. I don't think I necessarily had a particular love for the law. I think one of the advantages of a legal education and even a legal career is that it teaches you how to think analytically and critically. It requires a certain amount of intellectual rigor and an ability to express yourself. And I think those skills are extremely relevant in anything you do, particularly in finance, in investment banking, where you're always trying to persuade people to do what you want them to do.
And how did you experience Harvard and Yale?
Look, my education was a long time ago. I went back in the 80s and early 90s. Um, they were great schools, and I learned a lot, not just in the classroom, but from the people I went to school with, many of whom have gone on to extremely successful careers. Um, but, those were very formative years of my life. I was in the United States, but, I've met throughout my career as well, I've met a lot of really interesting and intelligent people. I feel very fortunate to have had contact with such talented people over the years.
Was it already very difficult to get into an Ivy League school back then?
Yes, yes, the schools were extremely competitive. Bear in mind, it's a little bit different in the U.S. So they don't just accept you on the basis of academic merit. They take into account other factors, some of which I think are quite relevant, some of which maybe aren't. But yes, it was very competitive even 30 whatever years ago. It's probably even more competitive and crazily competitive today because they draw in applicants from all over the world. What I would say, one of the changes I think I have noticed is that, and I've noticed this having interviewed a lot of candidates, is that you see a lot of really strong candidates from a wide variety of universities. And so, whereas I think maybe 30, 35, 40 years ago, there was a very strong bias in favor of, let's say, the Ivy League. I think that today employers are much more open-minded about what universities people go to. They recognize that there is tremendous talent all over the place, and they're really judging more the caliber of the candidate as opposed to the quality of the credential.
Yes, very interesting. And what did you do in your first years as a lawyer?
Okay, so when I finished law school, I worked for a judge for a year, a judge in Washington, D.C. He's still a senior judge there on the U.S. Court of Appeals. And that was very interesting. Again, not at all relevant to anything I did subsequently. But we dealt with a lot of cases involving administrative agencies. So think of the Environmental Protection Agency or the Securities and Exchange Commission. All these Washington agencies, a lot of times there would be appeals of their rulemaking and they would come to the court. And so I dealt with a lot of those cases, and it was intellectually very interesting. I worked for a brilliant judge. He's a specialist in antitrust law, competition law. And I learned, again, a lot about thinking analytically. He was a brilliant writer as well. And it really improved my writing tremendously, having to work for him. And then I worked for 3 years at a Wall Street law firm called Sullivan and Cromwell. I worked 2 years in New York and 1 year in London. In New York, I was working mostly on Latin American projects because I speak Spanish and I could get by in Portuguese. And then I moved to London to spend another year there, working mostly on Italian projects. These were securities. It was security. I was practicing securities law, so think of issues of stock and bonds, and that was my first exposure to the world of equity capital markets, you could say, which is where I ended up spending the vast majority of my banking career.
After all that, you decided to join Deutsche Bank.
Correct. I mean, working as a lawyer is hard. It was very hard work. I have nothing but great things to say about the law firm I worked at, but the hours were absolutely punishing. And I didn't love the work. I really liked the partners. I had huge admiration for them. And I really appreciated the culture of the firm, but the hours and the nature of the work didn't really appeal to me. Now you can say, well, didn't you work long hours as an investment banker? And the answer is I didn't work nearly as hard as an investment banker as I did as a lawyer. And I received a call from a headhunter in London that Deutsche Bank, which at the time was known as Deutsche Morgan Grenfell, was his trading name, was building out its equity capital markets business. This was in the early stages of the development of Deutsche Bank's investment banking capabilities. They brought in some teams, especially from what was then known as S.G. Warburg, later UBS. They brought in a bunch of bankers from there. They brought in bankers from Merrill Lynch on the fixed income side. And, Deutsche had a lot of ambition. And I thought that would be an exciting place to start my banking career. At the time, just so you know, I started as an investment banker at the age of 30. So I was very much a late starter.
And did you have to acquire any special technical skills when you joined Deutsche as an ECM banker?
None. I just needed to know how to think on my feet, talk on my feet, and do base 10 arithmetic. There were no skills. What I would say, and I would say this to all of your colleagues, is don't worry about what you study in school. Oh, I didn't take this course and would have helped me. It's irrelevant. What you need to do is to keep up to date on world affairs, on what's going on in the world of business. I would read the Financial Times or the Wall Street Journal. Keep up to date as to what's going on. Keep plugged in. Listen to people, but don't worry too much about what you're studying or what your thesis is on. Believe me, the reasons you're doing all these studies is to learn how to think, It's not what you learn, it's how you approach the learning.
All right, Craig. And would you agree that this is still valid today?
Yeah, I think so. I mean, unless, you want to be trading in some sort of derivatives and you need advanced mathematics or something like that. I think very much so. When we used to interview candidates, we wanted to see how they could think. It's not difficult to learn how to, model something. I guess it's probably useful to learn all the different shortcuts on Excel. To be honest, I never learned them.
Yes, and you also don't learn really Excel shortcuts at uni.
I didn't know any. First of all, we didn't have Excel. Okay, it was Lotus 1, 2, 3, and I didn't even know how to use that. But a lot of the skills you learn on the job, or you can learn practically. Okay, how to research something, how to model something. It's really knowing how to think, how to question, how to draw distinctions, how to know when something is different, how to know when there's a distinction without a difference. That's what you're looking for. When you speak to clients, I mean, investment banking is a client business. The analysis is kind of commoditized. It's that next level of thinking, of rigor, of creativity, of independence of thought. That's really the value that you can add above and beyond what everybody else can.
I see. So you also interviewed liberal arts students?
Very much so. I think actually in the London office, most of the Oxford and Cambridge graduates, I think the number one area of study for the Oxford and Cambridge graduates is classics. Nothing to do with investment banking. You can't even use the languages, okay? I mean...
Can you briefly explain what you mean by classics so that...
Classics is Latin and Greek. Reading the old classics. But they had discipline in many cases. They had a disciplined approach to their work. They had a great work ethic. And they, could remember, could synthesize. I think that's important. I would also say to the students of Mannheim, you need to have a very good command of business English. The students nowadays from the continent speak good English, even if it isn't their native language.
Great. And what led you to join Bank of America as a managing director after 8 years at Deutsche Bank?
I had been at Deutsche 8.5 years. There were ups and downs. I wasn't particularly happy about some of the developments within my team and within the bank, although I didn't realize just what the kind of difficulties the bank was going to find itself in. I had an approach from Merrill Lynch, as it was then known, in 2005. I knew some of the people in the equity capital markets team, and I thought they would be great people to work with. So it was a little bit of push and a little bit of pull.
And you were also responsible for capital markets at Bank of America in the APAC region during COVID. How did you experience this time?
Well, on a personal level, it was obviously very challenging. My wife and family couldn't join me because of the quarantine situation. I couldn't travel to visit clients. That was quite frustrating, having to do everything on Zoom. But on the other hand, it was a very busy time, especially in China equity underwriting. There was a huge amount of activity up until, I would say, the middle of 2021. I mean, it was just one deal after another, and that was really exciting. You may recall that during COVID, there was a bit of a boom in tech stocks, and China had and has some of the biggest and most interesting technology companies in the world, and they were listed on Hong Kong or on NASDAQ, and so they needed American banks to raise additional capital for them. So it was a very exciting time to be to be in Asia, even if on a personal level it was quite a challenge.
Craig, let's now focus a little on equity capital markets as a product group in a bank. Since this is also meant to introduce students to ECM, perhaps you could start by clarifying what exactly ECM bankers do.
Great question. So first of all, equity capital markets, what is it? It's the team that is involved in originating, syndicating, executing offerings of shares, offerings of convertible bonds and exchangeable bonds, what are called equity-linked bonds. Anything having to do with shares. If somebody is raising money using shares, that passes through the equity capital markets desk. You sit on the private side, so you sit on the investment banking side of the Chinese wall. In other words, your clients are the corporates, they're companies, they're big companies. But you are the link between, you might say, the people the investment bankers who cover the company day to day, and the investors who are going to be buying the shares or the paper that you're trying to place. You are the linkage between the two. You're trying to bring in the business and then you're trying to get it out the door. So it's very much a role in which you have to work well with colleagues on the investment banking side, but also on the global market side. Global markets, in this case, would be equities. So the people on the public side of the Chinese wall who speak to investors. So say you're a German company and you want to IPO. Well, somebody in equity capital markets goes to you, shows you ideas, tells you, here's how I would structure the deal. Here's the kind of valuation you can expect. Here's how I would suggest positioning the company. Then if you get the mandate, and bear in mind, these are very competitive, okay? There's a lot of banks going to these companies. Then you're working with your syndicate desk to adopt the strategy for, okay, which investors are we going to approach? How are we going to approach them? What's the follow-up with these different investors? How is it all going to work? So we are kind of the glue between investment banking division on the one hand and the equities division on the other hand, which is between the private markets, the private side of the business and the public market side of the business. We are the glue between the two.
Can you further elaborate on how the ECM group is structured internally and explain the interaction between various subgroups such as equity origination, ECM syndication and convertible bonds, and also distinguish the ECM group from other product groups such as M&A or DCM?
That's right. Yes. It's correct. They are divided into different subgroups, although they are not siloed. Everyone is sitting together. So you have your originators. They will tend to be senior people who will go and speak to the big companies or the private equity firms and say, look, you want to be working with us, here's how I would do your deal. And so you're an originator. That means you're pitching, you're selling the bank. You're saying, please use my bank, not this other bank. So when I was at Bank of America, I'd say, please Bank of America over JP Morgan or Morgan Stanley. And of course, JP Morgan or Morgan Stanley or Goldman Sachs would go in and say, you want to be using us. You don't want to be using these other guys. That's what the originators do. And they have people who work with them to help them prepare materials and analyses to present to the clients. In Europe, it varies a little bit between the States and the rest of the world. In Europe, we tended to divide responsibilities on a geographic basis. So you'd have somebody who would cover Germany, Austria, Switzerland because they spoke German. You'd have somebody who'd be covering France because they spoke French. Maybe you'd have somebody covering Southern Europe because they spoke Spanish or Italian and they would cover Southern Europe. You'd have somebody covering the UK who usually would be a Brit and so forth. Somebody covering emerging markets. It's the same in Asia. So in Asia, we'd have somebody doing Japanese equity capital markets and China equity capital markets. And it's very geographically driven. In the US, we don't divide it by geography. We divide it by sector. So you'd have somebody who did healthcare equity capital markets, somebody who did tech equity capital markets, and so forth. So those are the originators. Then you have your syndicate desk. Your syndicate desk is there to speak with investors. And in Europe, they speak on taped lines, and they maintain the day-to-day dialogue with the key investors. Here, they talk about the deal dynamics. They try to sound them out about what they think. They also are linking up with the sales force, who also speak to investors. So sometimes the syndicate desk is the one that speaks to the investor, but sometimes it's also the sales force, and it really depends on which investor. Bear in mind that you could be marketing the deal to hundreds of investors, and so it's not practical for the syndicate desk to speak to every one of them or even most of them. But the syndicate desk will speak to the top 20 buyers 10 normally, and you'll have the sales force speaking to the rest. But the syndicate desk is there a little bit, the way I would describe them is like the number 10 on the football pitch. You know, they're the playmaker. They're passing the ball here and there, making sure people are in the right positions. They're dictating the tempo and cadence of the deal. Very important. Another way to describe them is the central nervous system of equity capital markets. Now, separately, you would have two other teams, but they would all be sitting together. One team would be the equity linked team. So that's for convertible bonds, exchangeable bonds. That's quite a unique product. It's quite a specific product, but it sits within equity capital markets. It's more technical than I would say the kind of the normal equity underwriting product. So you need to have people who know what they're doing. They need to understand how to do a Black-Scholes model. Again, you can learn it on the job. It's not that difficult. In fact, we all have these models, and so it's pretty straightforward. But there is a bit more of a learning curve involved in equity linked. And the final team, and not every bank has this within equity capital markets, but we certainly did at Bank of America, is your strategic equity solutions team. This is a team that does corporate equity derivatives. So when you had a sovereign wealth fund, a private equity fund, or maybe a corporate that had a stake in another company, this team would help them hedge it. They could borrow against it via margin loan. They could do something around it, usually derivatives oriented. Again, the team, this is also slightly more specialized, slightly more technical than the mainstream equity underwriting product. You do need to be trained up a little bit more. Again, you learn it on the job. But those are kind of the four, you might say the four little areas within an equity capital markets team. But bear in mind, equity capital markets team in Europe isn't that big. I don't think I ever had more than 50 people, 40, 50 people on my team in Europe. So we all had to work in together. We all had to muck together. And sometimes you'd have to move somebody from one team to another because it was busy in one area, not the other.
In which of the mentioned areas did you spend the most time in?
Yeah, I was always an originator. So I was always an originator, but I got to learn the other products pretty well. So I first of all, because I was running the team, and so I had to understand equity linked. I had to understand strategic equity solutions. So I couldn't just sort of sit there above. But also because, about over 20 years ago, say 2001, 2002, 2003, the IPO market shut down after the TMT bubble had burst. Straight equities was very slow. And so I was pitching a lot of equity linked deals with partners in the equity linked team, but I was doing a lot of the pitching myself. And so I needed to be able to understand the product at quite a good level of detail in order to be able to present to clients, because sometimes I would have to do it on my own. And so I learned on the job about the other products, even if generally speaking, my pedigree was origination.
Could you now briefly elaborate on what products and services does the ECM group usually offer its clients?
Sure. So you have IPOs, initial public offerings, when you want to list a company. The most recent big one in Germany was the Douglas IPO, which I think you may be the perfume retailer. Then you have rights issues. So so when a company issues, a listed company issues shares, a large amount of shares, and they do it by giving a warrant to each of their shareholders to subscribe for new shares. And the bank tends to underwrite that rights issue. So they tend to guarantee the proceeds of that rights issue. And those deals can be quite interesting. So one big rights issue I worked on in Germany was for Bayer as part of its acquisition of Monsanto. And this would have been in 2016. A more recent example was just announced yesterday in the United Kingdom by National Grid, which announced a rights issue of £7 billion. So that's a very important product for equity capital markets. We also do block trades and accelerated book builds. So a company has a stake in another company, it wants to sell it, it wants to sell it fast. So you do a sort of an overnight placement. Sometimes that is done on a best efforts basis. Sometimes it's done on an underwritten basis by the bank. That is a very key product in the equity capital markets group. Another product, obviously, in the equity link side, the two main products are convertible bonds and exchangeable bonds. Convertible bond is you issue a bond, fixed income instrument, that is convertible at a premium, a 30%, 40%, 50% premium to the share price. It's convertible into shares. An exchangeable bond is the same thing, except the issuer is a different company from the underlying. So let's say you have a stake in another company, you can issue a bond, so you're borrowing the money, but the bond is convertible into shares of another company at a higher price. And on the corporate equity derivative side or the strategic equity solutions side, the biggest product is margin lending, so lending against someone's stake, and you have certain loan to value metrics that you look at, but also in addition there are various hedging solutions. So somebody has a stake in another company, they want to hedge it in one form or another, and the team executes on those deals. A lot of those deals are not in the public domain. So whereas an IPO, an accelerated book build, a rights issue, a convertible bond, an exchangeable bond are all publicly announced, they're in the bright lights, the press talks about them. A lot of what the corporate equity derivatives team or strategic equity solutions team do are not publicly disclosed. They're highly confidential.
Thank you, Craig, so far. And what are the major differences between IPOs and FPOs in terms of preparation and deal execution?
Sure. So let me just start by saying FPOs are relatively rare. Fully marketed secondary offerings are relatively rare nowadays. Nowadays, once a company is listed, 9 times out of 10, if there are further sell downs, you do it on an accelerated basis. So what does that mean? For an IPO, there's a tremendous amount of upfront work. You got to get the company ready to be a public company. Okay? You got to prepare a prospectus. You got to prepare research. You got to prepare all sorts of presentations. You got to prepare the roadshow. I mean, it is minimum 6 to 9 months, in many cases years, because the company needs to overhaul a lot of its processes to get there. Becoming a public company is a big deal. It's a big expense, requires a lot of preparation. Once you're public, things get a lot easier when you want to raise new capital. So if it's a follow-on offering with a prospectus, okay, you have to prepare a prospectus and update investor materials, but the company's already listed. Most of the time, when people want to sell more shares, they can just do it on an accelerated basis. And that doesn't even require a prospectus. It just requires a press release. You have an underwriting agreement. It's basically very documentation light. If there's a rights issue, you do have to prepare a prospectus. And you will need to do investor presentations. But again, the preparation period is much shorter because the company is already publicly traded. So really the two distinctions are, first, whether you have to prepare a prospectus or not. And if you ever look at a prospectus, it's really big, it's really thick, it's a tough read. The lawyers draft it. It's a horrible experience for a lawyer. And in my experience, I noticed that many investors don't read it in all that much detail. And then the second is whether the company needs to sort of put in place processes associated with being a public company. That happens in IPO stage. Hopefully, it shouldn't be happening at a later stage.
And why exactly are FPOs so rare?
Because you can raise the money. In most cases, you can do a sell down with on an accelerated basis. So why do a fully marketed offering? You're incurring huge expense by doing another prospectus. You can be on the road for 7 days, during which time you can have hedge funds shorting your shares and causing all sorts of mayhem. It's much better, if possible, to do it on an overnight basis. And the capital markets in Europe and the US in particular are deep enough to allow you to do it on an accelerated basis. So you can launch at 5:30, 5 in the afternoon and finish up before the market opens the next morning.
Most recently, you were responsible for the APAC region at Bank of America. Are there special issues regarding ECM in different regions?
Yes and no. Look, every country has different regulations, but broadly speaking, there's a fair amount of uniformity across the world. And in addition, if you work at a large bank, they will have common practices across the world. So our prospectus disclosure would be broadly similar in any jurisdiction. Now, maybe the lawyers would order it differently to reflect local regulation, but the principles remain the same, that you need to disclose everything that's material. The accounting comfort letters would tend to be the same. So there was a lot of uniformity, at least at a high level, across jurisdictions. Obviously, in Europe, you have the prospectus directive, and so you actually have a fair amount of similarity, whether you're dealing with BofA in Germany or you're dealing with a CNMV in Spain. And in fact, nowadays, even the documentation is often drafted in English anyway. So making things even more uniform. So yes, there are differences, but you needed to maybe understand a few of the sensitivities here and there. But there is actually tremendous convergence that has been taking place over the last 25 years between countries.
Now going a little into technical aspects, as an expert in this field, could you walk us through an IPO process to help us understand it better?
Sure. Let's take an example. I'll give an example, not a real world example, but a hypothetical. Let's say private equity firm has a company in Germany, really good company in Germany. I don't know, chemicals company in Germany. So you've identified, you've scoped it out, you saw that they bought it 4 or 5 years ago, you know that the business has improved, and you figure, well, they're probably looking to float it. So you go call up the private equity firm and you say, what are your thoughts about this company? Are you looking to exit? And they'll say, yeah, maybe. And you go, well, can I come and visit you and present a few ideas? And they go, okay. So what I would do is I would go with my investment banker. So I'd probably go with somebody from the Frankfurt office, and somebody who was a specialist as well in the chemical space, let's say. And we'd go and we'd prepare a presentation, and we'd talk about, how we see the company, how the company would be positioned, how the company would be valued in an IPO, who the peers would be, would be benchmarked against this other company which is listed, or that other company would be listed, what the valuation multiple would be. Would it be valued on an EV/EBITDA basis, PE basis, some other basis? Would it be at a premium to those other peers, at a discount? Why? What's the best timing for a deal? So you do a whole pitch. And by the way, you probably have to go more than once. And then there might be a formal bake-off, a formal, we call beauty pageant, where they call you in, and then they call in another bank right after you, and another bank right after you, and there's 10 banks, and you're all pitching, and you're all trying to look pretty, and you bring your teams, and then you hope that they'll select you as one of the global coordinators, which is the top line of the deal.
And what are the most important aspects?
Good question. Relationship, but relationship can be built on if you've done work for them in the past, if you provided credit or if you provided some sort of capital commitment in the past or in this current situation. They'll also want to know what valuation you think it can be pitched at. One of the ways you lose a deal is by showing too low of a valuation. Now you might say, well, yeah, but what if that's what the company is worth? And this is a very fine line between, you need on one hand to present a credible valuation. You can't just tell them, oh, you're worth 10 billion euros when the company's really worth 3 billion euros. But on the other hand, you need to show what I would describe as measured optimism. They want somebody that they think can sell the shares in a convincing way. But there are a lot of different factors, and you lose more than you win. It's a fact of life that even the number one bank in European equity capital markets has a market share of 9% or 8% or something. So you're always losing more than you win, and you just have to take it on the chin when you lose. And I've lost many, many, many times. So you get the mandate, you've signed the mandate letter, probably negotiate the mandate letter. That's, your lawyers have to approve the mandate letter, and you get to work. And so there's various work streams on an IPO. One that sort of focuses on the documentation, the prospectus, the underwriting agreement, all that stuff. Then there's one that focuses on marketing, which is you're preparing an analyst presentation, you're preparing a roadshow presentation. But to make a long story short, as the documentation advances and moves through the regulator, you have a parallel process where you initiate contact with a select number of investors. You'll often have what are called pilot fishing meetings, early look meetings, where you sound them out a little bit about the company, you show them a few numbers, you introduce them to management just so they get a little bit of a feel for it, so they can start doing some work around it. And in the meantime, you're also preparing for a presentation to the research analysts. The research analysts work for the banks, but they are independent. They are completely independent. That's a regulatory requirement, but they sit within the banks. And so you do a full day, really deep dive presentation to the research analysts, and they have the opportunity to ask questions. And then the research analysts have about 1 month to write their research reports. And they'll write a research report about the company, describing the company. Some banks, research analysts will put a valuation on the company. Others will just explain valuation methodologies. In any case, that research gets published, gets distributed to investors, not in the US, but everywhere else. And then the research analyst will spend a week or two going around talking with investors about the company and collecting feedback from investors on the company. On the basis of that, what we call pre-deal investor education, that's what it's called, pre-deal investor education feedback. And on the basis of the feedback that you've received from the early look meetings, the pilot fishing meetings, and so forth, you then go to the company and say, okay, we suggest you launch with this price range. So we're going to finalize the prospectus, and we want to go with a price range of, 13 to 16 euros per share, whatever the numbers are. And here's the reasons why. You do a very big presentation, going through the feedback in some detail. You analyze that feedback. You quantify and categorize that feedback. You also look at where the comparable companies are trading. You do a lot of work around it. And it's quite a big discussion with the company to make sure you have the right price range. If the price range is too aggressive, your deal will fail or struggle. If the price range is too conservative, then you're going to leave a lot of money on the table. So you need to get it just right. And once you agree the price range with the client, you print your preliminary prospectus. Sometimes you will hear the term red herring because in the US, the preliminary prospectuses have this kind of red disclaimer on it. But you print the preliminary prospectus or preliminary offering circular. You'll hear different words. So in the UK, sometimes they'll call it a pathfinder. And then you spend another week or two in the formal roadshow where the management goes to visit investors. And it's kind of like a horse and pony show. And they go visit investor after investor after investor in London, New York, and maybe Frankfurt or elsewhere. It's a pretty demanding schedule. The biggest challenge is, you'll have 8-9 meetings in a day, and finding the time just to go to the bathroom is a real challenge. And I kid you not. I think nowadays, with the emergence of Zoom and the ability to do virtual roadshows, you can hit even more investors and optimize your time even more. During that roadshow, at the same time as you have the roadshow, the investment banks that are leading the deal, they open the book, and it's called book building, and they build a book of demand. So they're taking in orders from investors, and it's called book building. And so that process is running parallel, and every day you're getting in orders, and every day at the end of the day you have a conversation with management and the owners. You have a conference call, and you tell them how the book is building, how the book is developing, who has come in, if there are price limits on the orders, if you're covered, if you're not covered, and so forth. And that's like a daily occurrence. Then at the conclusion of the roadshow, hopefully you have a covered book and a book that you can allocate shares. You close up the book. You agree with the client what the price is going to be within the range. So if it's 13 to 16 euros, maybe say, look, we could price at 16, but we think it'll be priced better at 15. You have a debate around that. That's another big presentation you have to do. You have to go through all the orders in the book and discuss them and discuss why you're making the recommendation you're making. And it is a big discussion. You're frequently having to also present to the board of the company. And it's often a very formal process. Not always, but it's often a very formal process. And it goes late into the night. You agree the price. You issue the press release. And then your syndicate desk spends all night, so they will not sleep, allocating shares to the hundreds of investors in the books, agreeing the allocations. So people put in orders, I want 100 million euros, and they get 20 million euros allocated to them because the deal is oversubscribed. And you allocate the shares, and then the shares trade at 8 in the morning or 9 in the morning, whenever the exchange opens. So that's kind of the process. I guess the last part of the process is stabilization. So When we IPO a company, let's say the company, you're IPOing a company and there's 100 shares you have to allocate. You actually allocate 115 shares. You always over a lot. So you allocate more shares, usually 15% more shares. If the share price goes up, you have an option to go to either the company or the selling shareholders and buy another and take down another 15% to cover that short position. If the shares go down, then you cover your short position by buying in the market, and that stabilizes the share price. That is a legal way of managing the share price. And there are very specific rules around that, but if the shares go down, you can stabilize in that way. And that's probably the last part of the process, is whether you exercise the over-allotment option, sometimes called a green shoe, or whether you stabilize in the market. Sometimes it's a bit of both, by the way. To give you an example, in the case of your Douglas deal in Germany, that deal traded down in the aftermarket. So the over-allotment option wasn't exercised, and it had to be, I assume the banks had to participate and stabilize.
Now that we have already dealt with ECM as a group in a bank, I would be delighted to hear your market outlook in order to look towards the future. Given your extensive experience in equity capital markets, what significant trends have you observed in the market over the past decades, and how do you foresee the role of ECM evolving in the near future?
Look, I think equity capital markets, a couple of observations. First, I think the business has become much more commoditized. The distinctions between banks in their distribution power is very small. Whether you hire Goldman Sachs, JP Morgan, UBS, in all likelihood, you're going to have much the same outcome. They speak to many of the same people. And so I think issuers now realize that the distinctions are very small between a lot of the banks once you get to a certain level. What that means, therefore, is that there is increasing competitive pressure on the banks. The syndicates are often bigger, the fee spreads are smaller, and it's just a tougher place to make money than maybe it used to be when I started out. The other issue and the other challenge for equity capital markets is what I alluded to earlier, the growth of private markets. A lot of companies prefer to stay private. They don't have, there are huge pools of private capital that they can access. They don't have mark to market. They don't have the public scrutiny that comes with being listed on a stock exchange. Not just scrutiny from shareholders, but scrutiny often from activist groups, from political groups. You're just much more visible. And for a lot of companies, they don't like that. I am a passionate believer in the social value of public markets, in part because of the transparency that they afford. But that's precisely the reason why some people like to stay private. In addition, I think, we have seen outflows from active fund managers in the equity space. Nowadays, allocators are either putting their money into passive products, so index trackers, or into specialist investments, private equity, real estate, some esoteric things. But the era of the fundamental long-only investor has kind of passed because of a prolonged period of underperformance. But paradoxically, you need those kinds of investors, those stock pickers, to support your equity capital markets offerings. And I think on the demand side, we've lost a lot of that liquidity, and that in turn has affected equity capital markets. It means it's harder to get some deals done, and that the aftermarket liquidity of the shares is worse. And sometimes you'll see an IPO in Europe, a big IPO in Europe, but by day 3, liquidity has dried up. And that's very frustrating because it makes it less attractive for investors to participate in European IPOs. And then you just have a kind of vicious circle that sets in. So I think right now the equity capital markets business faces challenges. It's not dire. It's still a great place to work. But it's just become a little bit harder than maybe it was when I first started out.
Interesting. And to what extent does this influence the overall attractiveness of the job for applicants?
I think, well, at the higher end, it certainly affects compensation. I think, without going into too much detail, I think for managing directors, compensation is lower today than it was.
Does that mean that fewer people will be hired?
No, we still get really good talent. It's always been a place for global people, for international people, for entrepreneurial bankers, or what I would call bankerpreneurs. And I think that's still the case. It's just, it pays less, especially at the higher end, even on a nominal basis, so not adjusting for inflation. And that's because it's less profitable. It's more commoditized. And that's just the way of life. And I think also there's, it's hard to map it on a year-by-year basis, but generally speaking, there's less activity.
Craig, what is your prediction? Will ECM still exist in 30 years?
Yes, but I think equity capital markets is overdue some sort of disruption. I mean, the way the teams do deals today is pretty much the same as how I did it when I started in 1997. To some degree, I used to joke that we are analog bankers in a digital world. And I just think there are opportunities with technology to optimize processes and to improve execution. Maybe the technology isn't quite there, but it does feel like it's due for disruption. Then again, I've been saying that for the last 10 years and nothing's changed. So who knows? You'd be surprised how slow change can be, especially in a business that's very bespoke. Equity capital markets, it's not prêt-à-porter clothes. It's haute couture. It's very made to measure. And those types of businesses don't lend themselves that easily to automation. By contrast, on the sales side, that business has changed completely. Equity sales has changed completely.
You mentioned sales. How exactly has this changed?
Well, it's changed because nowadays investors trade electronically much more. They don't just call up their broker. They don't really pay very high commissions. They don't pay, they don't read the research in many cases. And the equity sales that used to be a big job, a very high prestige job, but it's become really commoditized. And in some ways, they've been disintermediated. The sales teams are much smaller than they used to be. So it's gone from high touch to low touch. That is a huge change on that side of the business over the last 25 years. But that change hasn't been replicated so much on the other side of the Chinese wall.
Yes, and how have recent global economic changes and uncertainties impacted equity capital markets, and what strategies do you believe are most effective for navigating these challenges?
I don't know if they have changed. Look, I mean, equity capital markets is going to be driven by what happens in the broader markets, what happens with interest rates. Equity capital markets had a great period of time and during the TMT bubble, during the COVID bubble. And then obviously when that burst and things slowed down and activity slowed down, I think the biggest challenge right now for equity capital markets is that a lot of private equity acquisitions happen at very elevated levels. And so it's very difficult to take a company public at a lower valuation than where you bought it. And that's gumming up the system a little bit. So even though equity markets are at all-time highs, equity capital markets activity hasn't fully recovered. But geopolitical events, obviously, investment banks aren't doing a lot of IPOs in Russia. They're not doing any activities in Russia anymore. China has slowed down dramatically. It's literally fallen off a cliff in the last 3 years. It went from being super active to being, basically came to a screeching halt in the back end of 2021, and it has not reopened really. But, the broader markets are relatively immune from political developments. I mean, that's one of the great surprises. You read about war, famine, horrible events, and yet the markets seem to brush them off. So I think, for equity capital markets bankers, my advice is to be well informed about what's going on in the world. Understand, what's happening with the green transition. Understand what's happening with electric vehicles. Understand what's happening with AI. Be a well-informed citizen of the world. That is my number one advice. And that will make you able to pivot to the sectors that need capital, or to the countries that need capital, or where there's the most activity. I don't think you can plan it in advance other than just be well informed.
Thank you very much so far, Craig. And now I would like to move on to the last part of the podcast interview and also ask a few personal questions. Are there any cases, IPOs, FPOs, etc., in your professional career that you remember in particular and would like to share with us?
Wow, there's so many of them. Look, I worked on a lot of deals over the years. I think, some of the most fun deals I worked on were in the luxury goods space. So I worked on the IPOs of Moncler and Brunello Cucinelli in Italy. I worked on Jimmy Choo's IPO in the UK. And what's always great is just to meet the personalities behind these companies. They are not capital markets bankers. They're very different styles. But, you need to be able to speak in a way that they can understand, that they feel comfortable with. They want to sense that you empathize with them and that you're on their side. And so lecturing them in a kind of bankerly way will backfire. And, I think empathy is an incredibly important skill to develop. And so when I think of the IPOs I've done for, companies that are really cool, really interesting, but they're not bankers, these people. I learned as well as I could of how to speak their language and understand their business and look at the world through their eyes. And I think empathy is something that really, has come out of, the importance of empathy is something that it's very easy for new bankers to overlook.
So understanding your client needs and a deep client relationship is key.
Absolutely. Understanding where they're coming from, what they're worried about. And bear in mind, they don't always trust you. They think you might be trying to undersell them, or you might have another agenda. Clients don't necessarily trust their bankers. And you have to understand that. And you have to think and act understanding that they are subjecting you to strict scrutiny and they are skeptical about your motives and your actions. What you do has to be beyond reproach.
In your experience, how do the tasks and duties of junior and senior bankers differ in equity capital markets, and what were your responsibilities as a vice chairman?
Look, I think your question is, how do your responsibilities change over time? First of all, I came to Merrill Lynch as a managing director. Let me be clear. These titles are all very impressive, but the banks are run in a way that you have to be a player manager, whatever your title is, group head, vice chair, you're a player manager, okay? Which means they want you playing more than you're managing. They want you on the pitch. They want you bringing in business, developing client relations, okay? Whether you're managing director, head of EMEA Equity Capital Markets, global head of equity capital markets, vice chair, co-head of Asia Pacific Capital Markets, whatever the titles I had, the job didn't change that much. My job was to talk to clients, originate business, manage teams in a way that they would work best. That means that I needed to lead by example. I needed to show integrity. I needed to act in a way that, act in the way of a role model for bankers, and just set a good example. It doesn't matter the title. What matters is what you do on a day-to-day basis. I think it's very easy to get caught up in these titles, but bear in mind, investment banks have a lot of marketing titles. A vice president at a bank isn't like the vice president of the United States. Okay, a vice president at a bank is a mid-level person. Most managing directors manage nothing and direct even less. So don't get caught up in these titles. The key is that if you're a senior banker, you're there to represent the bank, you're there to bring in business, execute it to a high standard, set a good example, mentor the junior population, and make sure that everyone is aligned and working towards a common goal.
If you observe students at the beginning of their career, based on their characteristics, can you already tell whether these students will succeed as ECM bankers or bankers in general? And if so, what are these characteristics?
Look, I think it's very hard to say at the outset if someone's going to be successful or not. Certainly some people seem to get it earlier than others, but I've seen a lot of bankers improve massively over the years. And if you're always learning, there's always room for progress. What do we look for? You look for somebody who can articulate themselves clearly, their ideas clearly and concisely. You look for somebody who has a good work ethic. And you look for somebody who's a straight dealer, who you can trust. I mean, sometimes you can tell when people prevaricate, when they aren't speaking honestly and directly with you. Investment bankers are very clever people, and we can see through, forgive my French, we can see through BS very quickly. And so my advice to any prospective candidate is to be direct, to be clear, and to be concise. And if you can articulate yourself in a clear, concise manner, if you can speak directly, I think you'll go a long way as long as you have a good work ethic.
In addition to this question, which avoidable mistakes did you often see young ECM bankers starting their career at Bank of America do?
Well, one of the big mistakes is to be disliked. We are in the business of being liked. If clients don't like you, if colleagues don't like you, you will not last. So if you're arrogant, if you think that you are the hottest thing in the world, you will likely fail, and fail fast. Really, arrogance, condescension, treating juniors or treating staff poorly, those are mortal sins in my book. And I think that is where so many people come a cropper, because they've done well in school, they think they're really clever, they walk in and they don't show the appropriate attitude towards their colleagues, towards their juniors, towards their staff, towards their assistants. Believe me, we pick up on that stuff immediately.
When you look back on your own career, what was right and important, and what would you do different today?
Well, I probably would have gone into private equity had I known how much money you could have made. But okay, listen. There's a saying: yesterday is history, tomorrow is a mystery, today is a gift, and that's why they call it the present. By the way, that saying comes from Master Oogway in the film Kung Fu Panda, which, okay, it's not exactly a philosophical tract, but I actually live by it. I think there are obviously things in your that I would have done differently here and there, people I would have cultivated, people I would have avoided, transactions I would have chased harder or done something different. But you're going to have setbacks in your career and you can't dwell on them. As I said before, I have lost far more than I've won in investment banking. And so has every other investment banker. Even the most successful investment banker has, what we say in America, a low batting average. So you just can't dwell on it. You learn from your mistakes, you move on. And I don't really look back and say, oh, I should have done this, I could have done that, I would have done this. I had a great career. I met some really interesting people. And, as Edith Piaf sings, je ne regrette rien.
At the moment, you're working as a retired banker for CEDA Experts and also write for the Financial Times and Global Capital. Are there any future plans you would like to share with us?
Look, I picked up the writing a little bit by accident. I was approached by the editor of the Financial Times Alphaville, which is the non-paywall part of the Financial Times. And he said, hey, I saw that you've taken career retirement. Would you like to write for us from time to time? And I thought, let me think about it. And then I started writing, and I had a huge response from people in the industry, huge. And people I didn't know, and so I kept writing. And I've now written 50 columns on the FT website. And then Global Capital approached me about having a weekly column, and it alternates between one week I write about life as a banker, and the next is an advice column, which, by the way, you're all welcome to email me for advice. And so I've been doing that as well. It's been a lot of fun, and I really have enjoyed it. It still is my side hustle. I'm doing it because I'm interested in the business, because it also keeps me in touch with people. It gives me great access as well. But it's not the same thing as working in banking. So I've really enjoyed the writing. I've enjoyed the people I've met through the writing, and it's also forced me to think about the industry in a different way. But no, so I've been doing expert witness work, for basically for U.S. litigation. I've also been a consultant, on an ad hoc basis for a couple of different firms. And, I've been traveling a lot. So I just got back from hiking with friends. We did the West Highland Way in Scotland for 7 days, and then we hiked up Ben Nevis on the 8th. I'm going to Morocco at the end of this month to hike up Mount Toubkal and then go kite surfing in Essaouira. So, I'm kind of enjoying my life a little bit as well. But it's a little. We'll see what I end up doing. But for now, I'm having fun. But I'm also really enjoying the ability to engage on a lot of these ideas. I'm very interested, as I said before, in the role of public markets, what they can contribute to society, the importance of public markets. I've focused a lot of attention on the role of London, the importance of, London as a financial center, the role it can play, and that's going to continue to be an area of great interest for me.
Dear Craig, thank you very much for your participation in this podcast. We very much appreciate it.
Thank you very much, and thank you, and wishing you all the best. And if you ever do want more advice, you should write to the Global Capital. I do have my advice column there, and I'll try to answer your questions on a confidential basis, or an anonymous basis, I should say.